Welcome to the deep dive. Today, our mission is to really cut through a lot of the panic we're seeing.
A lot of panic.
Yeah, a lot. And it all centers on this one single company that's been hanging over the crypto market, MicroStrategy, MSTR.
And it's not just, market noise. The scale of what they hold is just massive. They're the biggest corporate whale out there with billions in Bitcoin.
Billions.
So if they were ever forced to sell, you'd be looking at a tsunami, really. That would hit pretty much every crypto investor on the planet. The fear is real.
It's absolutely palpable. And that core anxiety, that idea of a forced liquidation, a massive market crash, that's what we're tackling. But our deep dive today, which is guided by some really sharp analysis from Matt Hougan at Bitwise, argues this whole thing is, well, it's deeply flawed.
Yeah, our sources are basically saying the market is completely misreading MSTR stability. Hougan's quote is that anyone thinking there's a doom spiral coming is completely wrong.
Completely wrong. Okay.
So we're going to peel back the layers here, look at their balance sheet, their debt, their cash, and really figure out why he thinks this company is, as he puts it, solid as a rock.
Okay, let's unpack that. I think
Yeah.
we have to start at the source of the panic. What was the trigger? What actually set the market on edge?
It was a single statement, almost a throwaway line, really, from the MSTR CEO, Phong.
Right.
He just mentioned that the company could theoretically sell some of their reserve Bitcoin, but he framed it as this very distant, last resort kind of thing.
And of course, the market only heard sell Bitcoin.
That's it. And from there, it just spiraled into this worst case scenario, the doom spiral.
Let's define that for everyone listening. What does that spiral actually look like? Why is it so terrifying in theory?
It's this vicious cycle, right? It's all built on fear. The theory goes that if MSTR's stock price drops hard, maybe the whole market is down.
Sure.
It could fall below the net asset value, the NAV of the Bitcoin they're holding.
Okay, stop right there. Let's get a quick definition on NAV in this context. What are we talking about?
Think of it simply as the value of their Bitcoin minus their liabilities.
Yeah.
So the critics, the bears, they argue that if the stock price sinks below what the Bitcoin they own is actually worth, it creates this huge pressure from shareholders, from the market, who see the stock as fundamentally broken or mispriced. And that pressure, in theory, could force them to do something.
So pressure forces them to sell. They start selling Bitcoin to try and stabilize the stock price.
Exactly. But they hold so much that even a small sale could just flood the market, which would immediately push the price of Bitcoin down.
And a lower Bitcoin price means a lower NAV.
Which then drags the stock down even more. And there's your feedback loop. It's a self-fulfilling prophecy of liquidation.
It sounds devastating, but I have to ask the question I see all over social media, which is, doesn't the sheer size of their holdings mean any sale tanks the market? Isn't that the fear, regardless of why they're selling?
That's the narrative. And that is precisely what Hougan is pushing back against so hard. The volume matters, yes, but the reason for the sale is everything.
How so?
Well, if MSTR sells because they're solvent and just rebalancing their portfolio, that's one thing. The market can absorb that. But if they're selling because they're going bankrupt, that's a catastrophe. Hougan's entire analysis is that the first scenario is distant and the second is basically impossible if you look at their books.
Okay, let's do that. Let's move past the speculation and get into the cold, hard corporate finance. His first point is about their cash.
Their massive cash pile. This is liquidity management 101, but on a huge scale. MSTR is sitting on an incredible amount of dry powder, specifically around $1.4 billion.
$1.5 billion in cash. I mean, that's not just a buffer, that's a fortress wall.
It is. Hougan calls it a very comfortable cushion, and it's designed to absorb market shocks. It means even if the stock drops, even if we're in a nasty bear market, they have zero immediate internal reason to sell their main asset Bitcoin just to pay salaries or keep the lights on.
They can just ride it out.
For a long, long time.
And that fits perfectly with Michael Saylor's whole philosophy, right?
Right.
He calls Bitcoin a lifetime asset. You don't sell your lifetime asset to cover short-term costs if you have $1 billion in the bank. So the internal pressure is basically zero.
Exactly. Which brings us to Hougan's second point, which might be even stronger, and that's their debt structure.
Right, because in the corporate world, forced selling almost always comes from...
Market call, yeah. And MSTR is famous for using debt to buy Bitcoin, so everyone's watching those payment schedules.
So what do they look like? Is there a big bill coming due next month?
Not even close. This is the strategic part. They have staggered their debt so that they have no principal payments due until 2027.
2027.
I mean, just think about that breathing room. We're talking years, not quarters. They are not in a position where a dip in Bitcoin's price is going to trigger some massive repayment event.
Wow. That timeline, 2027, it just completely undermines the idea of short-term pressure. The argument for an immediate doom spiral kind of evaporates right there.
It really does. But you still have to deal with the interest payments. Right, they have to service that debt. What do they owe every year?
The sources say it's about $800 million annually in interest.
Okay.
So let's connect the dots. They have $1.4 billion in cash and an $800 million annual interest bill.
And that math is the fortress itself. That cash reserve covers their entire interest expense for nearly a year and a half.
17 months, roughly.
17 months without selling a single Satoshi. So Hougan's point is that the short-term financial pressure is, it's nearly zero. They've bought themselves time. They designed this.
So the narrative is they're panicked and over-leveraged, but the reality is they're leveraged and completely prepared. Okay, here's where it gets really interesting, though. Hougan's third point. It's not just about avoiding disaster. It's about their actual profitable position.
This is such a critical point, both psychologically and structurally. They aren't just surviving. They're way ahead. We have to look at their cost basis.
The average price they paid, what's the number?
The average cost for their entire massive BTC stack is around $74,436 per Bitcoin.
74,000. Okay, so that number is huge because it tells us they are not underwater.
Right.
But why else does it matter so much when we talk about forced liquidation?
It's all about equity. A retail trader might get leveraged 10 to 1 and get liquidated if the price drops 5%. But MSTR's debt is in long-term bonds, not some volatile margin loan.
Right.
Being so far above their cost basis means their equity in the holdings is huge and positive. Even with all the recent volatility, when Bitcoin was at 92,000, MSTR was still up something like 24% on their whole investment.
So let me get this straight. They're sitting on massive, unrealized profits. They have a year and a half of cash to pay their bills, and their first big debt payment isn't until 2027.
That's the picture.
It sounds like they are about as far away from having to consider selling as you can get.
Exactly. They're operating from a position of strength, of profit, not panic. But that's the internal story. We can't ignore the external stuff, which is what drives the headlines.
You're talking about the MSCI index risk.
I am. The risk of getting kicked out of major indices.
Okay, that's where the recent selling pressure came from. Why did MSCI suddenly decide to propose this? What's the rule?
They're proposing a new rule to exclude any company where over 50% of their balance sheet is crypto. And,
that is MicroStrategy's entire business model.
It is. So the fear for investors is simple. If MSTR gets excluded, all the passive funds and ETFs that track the MSCI have to sell their shares. It's programmatic, forced selling.
And forced selling pushes the price down, no matter how good the company's fundamentals are. We saw the stock drop pretty hard just on the rumor of this happening.
It did, but this is where Hougan's market experience really comes in. He's very skeptical. He argues that the actual impact of index changes is almost always way smaller than people think.
Why? Forced selling of billions of dollars sounds like it should be a big deal.
Because the market is smart. It's efficient. And it usually has this information fully priced in long before the actual rebalancing happens.
Can you back that up, though? Is there a concrete example?
He has the perfect one. And this is the real nugget. He points to last December, when MSTR was actually added to the NASDAQ 100.
Which should have been a huge positive catalyst.
It should have been massive. The model suggested that inclusion would require about $2.1 billion in forced buying from passive funds.
$2 billion in buying pressure. The stock should have rocketed up on that news.
And it barely moved.
Really?
It was a total non-event for the price. Why? Because, as Hougan argues, the smart money, the active investors, they had already positioned themselves. The fundamental value of the company, the Bitcoin, the clean debt structure, it was already known. The index change was just a formality.
Wow, that's a powerful example. It shows that these index flows aren't everything. The market freaks out about the announcement, but the actual event often just gets absorbed into background noise.
It shows that the internal strength of the company matters more than the external procedural rules. The whole fear narrative is totally undermined when you look at their balance sheet.
So let's bring this home. What does this all mean for us, for the listener? We've seen how this corporate whale operates, but how do we apply this to our own lives, our own investments?
Well, MSTR gives us three, I think, really advanced lessons in financial resilience. And the first one is all about strategic liquidity. It goes beyond just a simple emergency fund.
Right. We always hear, save 6 months of expenses. How does MSTR's $1.4 billion, which covers 1.5 years of their interest, change that concept for us?
It's about creating a real firewall between your living costs and your investment portfolio. MSTR's whole strategy ensures they'll never be forced to sell their core assets at the bottom of a market just to pay the bills.
That cash gives them the luxury of patience.
It's the ultimate luxury. For an individual, this means maybe aiming for a full year of expenses in cash. Something robust enough that you can ride out a multi-year downturn without touching your stocks or crypto at a loss.
Yeah.
I mean, calmness really does come from that level of preparation.
That's a great point. Okay, lesson 2, sophisticated debt management.
Yeah, modeled right after MSTR. They push their big payments off to 2027. For us, that means minimizing any short-term high-pressure debt, think credit cards, margin loans, anything with a variable rate tied to investing.
So instead of being scared of MSTR's debt, we should actually admire its structure.
We should. It's the difference between a long-term fixed-rate mortgage and, juggling high-interest credit card debt. When your debt is long-term and stable, you can be a long-term holder of your assets. If you have to sell something valuable to cover a bill that's due next week, you lose all control.
You lose the game.
You do. You invest with idle money, and you have a debt structure that doesn't threaten your cash flow.
And the third lesson, which I love, ties back to their cost basis, that $74,000 number, the discipline of knowing your position.
It's so important. MSTR knows their cost basis to the dollar. They know their equity cushion. As an investor, you have to do the same. You have to track your average entry points for your assets. That number is your anchor in a storm.
It's the difference between panicking when Bitcoin drops $10,000 versus just shrugging, because you know your cost basis is much lower and you're still fine. You're still solvent.
Exactly. Your focus shifts from the crazy daily price swings to the reality of your own personal balance sheet, your own cash flow, your profit. You need to have that discipline to ignore the short-term FUD.
That's the ultimate takeaway here, isn't it? Internal strength and real value are what matter. The market narrative about MicroStrategy being on the brink is just that, a narrative. And the fundamentals completely refute it.
Our conclusion is that MSTR is built to withstand a market winter. Forced selling is an incredibly remote possibility, not some imminent threat.
And this all raises a really important final question for you, the listener, to think about. The market spends so much time and energy worrying about all these external factors. It can't control index rules, regulations, what the central bank might do. Yet MSTR's leadership has just been laser focused on strengthening their internal fundamentals, building cash, establishing a rock-solid cost basis. So the question is, do you spend more of your time worrying about those external factors you can't control, or strengthening the internal ones that you absolutely can? Something to mull over. Thank you for taking this deep dive with us.